Welcome to the first of several lessons on capital budgeting. On this first lesson, we're going to talk about net present value, and this discussion will continue into a second lesson on that topic. Then we have some other topics also on capital budgeting, which will follow in additional videos. Net present value, or NPV as we'll be calling it, refers to the present value of all cash flows related to a given project and associated investments for a given company or entity. NPV is used as a method for making decisions concerning capital budgeting. If the NPV for a project is negative, then it is recommended not to proceed with the project. If the NPV for a project is positive, then it is recommended to proceed with the project. Right, so this is sort of a rule of thumb. There could be other factors, but just from the perspective of NPV, this would be the conclusions. The NPV can also be used to compare several projects. As we shall see, NPV is but one measure used to decide whether to go ahead with the project or not. So you may have several projects. Maybe they all have a positive NPV, and you probably want to pick the one that has the largest NPV in that case. So it gives you a method for comparing between projects. Calculation of the NPV depends on the stipulation of a given rate of return known as the cost of capital. And I've defined cost of capital down here. I'll get to that in a second. The general idea is that a proposed capital investment project should provide a higher rate of return than some other typically external investment of similar risk. I have an example here. If a company can make a 5% rate of return with, in their opinion, a moderate risk investment in the bond market, then an internal project with similar risk would be expected to make more than 5% a year. And then here we have the definition from Wikipedia of cost of capital. I'll read it to you, and you may want to pause the video and maybe take a second look at it after I read through it. In economics and accounting, the cost of capital is the cost of a company's funds, both debt and equity, or from an investor's point of view, the required rate of return on a portfolio of a company's existing securities. It is used to evaluate new projects of a company. It is the minimum return that investors expect for providing capital to the company, thus setting a benchmark for a new project has to meet. So we talked about two concepts on the previous slide, cost of capital and NPV. Let's summarize what we have. The cost of capital is the minimum return a company must earn on an investment to justify its risk and create value. It is used to evaluate projects, compare investment opportunities, and assess financial decisions. Investors and analysts also use it to estimate stock values and expected returns. The cost of capital and NPV are closely related, but they're not the same. The cost of capital is the required rate of return or discount rate used to evaluate an investment. NPV is the value created after discounting future cash flows using the cost of capital. So NPV measures how much value an investment adds after accounting for the cost of capital. Let's try to make these ideas more concrete with an example. Consider a small business, Acme Furniture, that makes custom furniture and does antique furniture restoration. The business is currently run by Alice and Bob in a converted garage. On a regular basis, Alice and Bob are turning down business because of lack of resources. To address this issue, they are considering an expansion of the garage, the purchase of additional equipment, the hiring of additional staff, additional parking spaces, and a small showroom for customers. The upgrade to their business will require an investment of $225,000, On the other hand, Alice and Bob could invest $225,000 in three other ways with the following semi-annual rates of return. So 2% conservative investment, banks, certificate of deposits. 4% moderate risk, government and corporate bonds. 6% higher risk, stock and higher risk bonds. Alice and Bob know their business well and are able to make, in their opinion, reasonably accurate projections of cash flows for the business expansion as a result of the planned expansion noted up here. The problem in hand is to compare the projected cash flows against the three alternative investment options, these three things here. So let's look at that on the next slide. So let's look at the cash inflow and outflow for the project by Alice and Bob. The top row is its time in half-year increments up to 5 years. I didn't have enough room on the page, so I had to continue down here. You notice it's 3, 3.5, 5. The second row contains the cash inflows to Acme Furniture, so that would be either the sale of furniture, or I guess they're also doing restoration, so that would be included in the this line here, the inflow. Then the third row contains the cash outflow. That would be the initial investment, the things like the equipment, the extension of the garage, the small showroom, the parking lot. That would be here. So, and that's the accounting technique. Usually they put things in parentheses to show negative. And then the bottom row shows the net cash flows for each 6-month period. So you can see here this was negative. You have to subtract the 10 from the 30,000. It's just subtraction in each case here. And so you have the net cash flow. And of course this is the important thing here, right? So they're kind of investing $225,000 up front, and then they're having these, you notice it's growing. I mean, it's just an example, but the idea is it's growing over time, so they would hope to recap their investment. Now, a couple of points to make here. One, I'm only looking 5 years ahead, so some investments may take longer than that. So if you cut off the horizon that you're comparing under, you may make the wrong decision. And then the other thing is we still need to compare this to the alternatives. They had these different stock and bond and bank note possibilities that might outweigh doing this. And if really what they're concerned about in the end is coming out with making more money after 5 years, then maybe some of those other investments outweigh this. Now, the other thing you need to keep in mind is the level of risk. So maybe some of these other investments are much higher risk than what they think here, because as I described the example, if you recall, they were getting more business that they could handle. So they may have a very strong feeling that it's just a matter of doing these expansions and hiring a few more people, perhaps on contract, that'll almost guarantee these numbers here. So that's the other thing to keep in mind. Then the last point I'll make, and it's a note here, is that I'm just showing the cash inflows and outflows total. I'm not breaking it down into, selling new furniture, selling restored furniture, doing repairs, and then the outflow would, be other things like materials and pay for the additional people they're contracting with and so forth. Now, the Alice and Bob may do that, but for our examples here, I didn't want to get more into the furniture business than we needed to. I mainly wanted to highlight the main points here. Okay, so let's continue. I'm going to do some of the technical mathematics on the next slide, and then we'll get back to this example on the slide after that where we compare to the other possible investments. Recall from an earlier lesson that we can compute the value of money realized at different times by computing the various values at some focal date. For our problem concerning capital budgeting, we will use the time of the initial investment, i.e. time zero, as the focal date and compute the values of the various net cash flows, so not the in and outflows, but just the net, for each period based on their value at the focal date. Then we have these general parameters here. C sub 0 is the initial investment, C sub k is the net cash flow for period k, which ends at time t sub k. I is the interest rate per period. We assume that's the same for all the periods. We could make the model even more general and allow this to change per period, but I didn't do that here. Then n is the number of cash flows. And with that, we get this formula. We have the initial investment, that's a negative. And then we have the time value of these net cash flows dated back to the time zero, the time of the initial investment. Right? Some of these could be negative. The formula allows for cash flows to be unequally spaced in terms of the number of periods. For example, we could have cash flow estimates at periods 3, 5, 11, 13. In that case, n would be 4, but then the periods would be 3, 5, 11, and 13. However, in our case, for the examples I'm going to give, I'm just going to assume that T sub k equals k. And we have this formula here. Okay, so let's go ahead and apply this to our example problem. So going back to our initial problem from a few slides back, we'll use the Microsoft Excel NPV function to compute NPV for the three different scenarios, 2, 4, and 6%. Remember, those were the alternatives in different types of investments. The Excel NPV function is easy to use. The first parameter is the rate of return, and the following parameters are the net cash flows for each period. And you can, if you just do a web search on Excel NPV function and look for the Microsoft page, it'll give you the formats and some examples to how to use that. But as I say, it's pretty straightforward. I showed the results here for our particular example. I put in the data. So for 2%, as an alternative, the NPV is positive. So the furniture company would do better with their investment. Then at 4% cost of capital, they're still coming out in the positive, but a little bit less. Then at 6%, they're way off. They're losing quite a bit compared to what they could do by investing. That's under the assumption that this 6% investment in some type of stock is of similar risk to their investment in their furniture company. So that's something that, for the couple to decide on. Then I threw in 5% just to try to get a little bit closer to where the break even is. So somewhere between 4 and 5, if you tested more numbers in here, you'd get close to like 0. So you could kind of hone in on the break even point. Now, another issue to think about, let's say they were thinking that maybe, 5 years is too short. What if you put in another year with 2 semi-annual periods? And I look at that case in the next page. So for the sake of argument, assume that Alice and Bob think that their risk in expanding their business is similar to the risk of the 6% capital alternative. So as we saw from the previous slide, it didn't make sense there. and I put in bold here, and I've mentioned this a few times, so I guess I'll just read it off to you again. This is a key point. The cost of capital needs to be the same estimated risk as the proposed investment. Otherwise, this analysis, isn't really valid. Was the given information, they should not go forward with the business expansion. We just saw that. However, it may be that consideration of a longer time frame for the cash flows will change their decision. For example, assume that they just look at a 6 year. So I've added two more, and let's say Bob and Alice are confident that they're going to do better here a little bit because they've been growing all along, at least based on their estimates. So they have that here. And then I used the Microsoft Excel NPV function again, and you see that they're doing even better at 2, 4, now 6%. They're actually in the positive because of this additional year that we added in here. And it's not until you start getting close to even 7%, it still would be advantageous to expand their furniture company, but it's not until you get around 8% where it might be better to put the money somewhere else. Okay, so these are just some of the factors. I realize it's not a full business analysis, but for someone who has a small company, they could just do it by ear, so to speak, without any analysis, which is kind of dangerous, or they could try to use something fairly simple like Microsoft Excel and some reasonable estimates based on their past business, and then looking at other alternatives for investing their money, and make a more informed decision in that case. The previous example showed positive cash flows for each period, but that doesn't always need to be the case. We can have negative cash flows, and I have an example of that here. The capital expenditures could be negative in some periods because startup issues, seasonal businesses, or expected charges like insurance payments at various points in time. As an example, consider a vacation resort that has a seasonal business, with fall being a time for repairs and reduced number of customers. The resort owners are considering a $500,000 investment to improve the resort. The table shows the estimated project cash flows for each season, each quarter, in a period of over 5 years. So you see here we have years 1 to 5, and they're making money in the winter, in the spring, and the summer, but in the fall, because of the off season, for whatever reason, they're doing repairs, so they're spending some money there. Maybe they have fewer customers, and so you have a negative net inflow outflow here. And on the next slide, we'll analyze this to see if there's any justification for investing this additional $500,000 up front. So that would be at the very beginning of this process. I have an analysis of the resort investment here on the right with some explanation here, which I'll go through. So we have the quarterly cost of capital and then the NPV associated with each one of these. And you can see that there's a break-even point somewhere between 2.5% and 2.5% quarterly, where you have a negative NPV. And the key for the resort is to determine the equal risk. Let's just say hypothetically that at 1.5% external investment is roughly the same risk that they see for their internal investment in the upgrade to the resort. So in that case, they would go ahead because they have a positive value here. But maybe they see the risk of their resort upgrade as being similar to 2.75% external investment. And so now that they have a negative NPV for their resort upgrade, and they might want to go for the external investment in that case, and maybe earn some money for a few years, and then come back and see if the resort upgrade makes more sense at that point. So, a lot of different factors. The cost of the upgrade may increase quite a bit in a few years, so maybe they're even willing to take a slight negative NPV in that case, looking further out into the future. So, a lot of factors, but this is kind of gives you some um, confidence, I guess you would say, in making a particular investment. You can always, look deeper into things with different types of analyses, but this is sort of a good start in terms of analyzing whether or not you want to make an investment in, in a company or a particular project within a company. So far, we've had examples that had a single investment at the beginning of a project, but it's quite possible that you need more than one investment over the course of a project. And that's what I'm showing in this example here. Let's have a look at the table. We have this project that goes over 8 periods. The first period has an initial investment, and then there's another investment at period 4. And so we've added a row here for the investment cash flow. It's this row here. And then we have another operating cash flow, which is the top row. And then we have the net cash flow. Before we were only showing the net, and we had the inflow and outflow. Now we just have operating cash flow, which could have input and output also, and the investment cash flow, which is typically just outgoing money. And then we add each column to get our net. And then we can do the same type of analysis here under cost of capital, yearly cost of capital. And you can see that the break-even point is somewhere between 5 and 6%. Up until that point, it makes more sense to go with this project. And then after that, it's if you can make more money outside with some other investment, it would be better to do that. And because you're actually negative in comparing that to the whatever this particular project is, this investment. In the previous examples, we assumed that the decision-making parties, those who are going to make the investment, had a pretty good idea of the future cash flows, but that may not always be the case. We have an example here where Mr. Throckmorton has only a rough idea of cash flow based on market analysis, and consequently he can only stipulate a range of projected cash flows for each period. So in each case, this range is based on an initial investment of $625,000. So we see that Mr. Throckmorton has a pessimistic prediction based on his initial investment over 10 years. And then he has a more optimistic prediction based on his initial investment over 10 years. So you can see that it's pretty much more in each year. So let's look at the NPV in these two cases and do some comparisons. I'll show you that on the next slide. The table I have here shows the NPV values for the pessimistic case and the optimistic case. In the pessimistic case, the cutoff is a little over 2.5%, or a rate of 0.025. And for the optimistic cases, you would expect the cutoff is larger. It's around 5.5%. Mr. Throckmorton may want to do a compromise and pick a number in the middle, like say 4%. If he can get more than 4% with an alternative investment of similar risk to the restaurant business, then he should not go ahead with the restaurant business. And the reason for picking 4%, in my rationale at least, was that if you look at the sum of the NPVs for the pessimistic and optimistic at each cost of capital, you notice this is positive, positive. This is still positive. If you add these two, this is positive, and you still get a positive sum at 4%, but at 5%, 4.5%, when you add this and this together, the pessimistic dominates and you get a negative value. So that gives you some rationale for going for 4% as the cutoff. This example illustrates an important practical issue with NPV analysis. The results are only as reliable as the projected cash flows and estimated cost of capital. In many real-world situations, these values can only be approximated. In the previous examples, we assumed the investors, the people investing in their company, had the money up front to make the investment, and that's not always going to be the case. In fact, it's probably more typical that they might need to borrow at least some of the initial investment money and then pay that off over the course of the the period of study. So that's something to be considered here. And I've extended the Acme Furniture example with Alice and Bob to take that into account. So I have the extended example here. Consider the Acme Furniture example where Alice and Bob need to take out a 5-year small business loan in the amount of $50,000 at a nominal interest rate of 3%, repaid semi-annually. So I'm trying to make things easier here with the length of the loan, and the payments for the loan are kind of in sync with the analysis that we did initially. That may not always be the case, but just to illustrate the idea, let's make things a little bit simpler. Under this scenario, Alice and Bob would need to make payments of $5,069 twice per year for 5 years. These payments need to be subtracted from the cash flow estimates as shown in the following table. We'll get to that on the next slide. In some locales, interest payments on debt are tax deductible. This will reduce the impact on cash flow, but we didn't consider this issue in our example, so it's one thing to keep in mind. While investment is entirely within the cash outflow category, operating cash flow entails both cash inflow and outflow. So this is just a reference to the table. Let's get to the table in the next slide. So we have the modified version of the investment scheme from the Acme Furniture for Alice and Bob. And what I added here was this investment cash flow. So there's the initial $225,000 that goes out, and then there's also these payments here. You notice they're all the same. That's for the loan they made. You notice the loan stops after 5 years, and then there's 2 years where there's no loan going out. Then we have the operating cash flow at the second row, and time well, actually it's in years, but we also have half years shown in here, and then we just need to add up the investment cash flow and the operating cash flow, and we get these numbers. So these are different from what we had before because of they had to pay back the loan in addition to whatever other expenses they had. And so we get a different result other than the last two, which since the loan was already paid off. So these last 2 years, two half years look pretty good. Okay, so let's take these numbers, the net numbers, and do the NPV analysis under these conditions. The bottom table shows the NPVs for various rates of return for alternative investments. In this scenario, there is a positive NPV up to and including 5%, this line here. Recall from the associated scenario without the loan, and I copied it for you here so you didn't have to page back. This was also for the Acme Furniture. It still made business sense to go ahead with improvements to Acme Furniture up to something over 7%, but less than 8%. This is to be expected since the loan decreases net cash inflow for each period. So no surprise there. they have kind of less wiggle room here, less flexibility because of they needed to make that loan, but still, in the end, they could make money with their expanded furniture business. In the above example, the loan is fully repaid by the end of year 5, as we saw, while the cash flow projection continues through year 6 for 2 more semi-annual periods. This means the analysis includes 1 additional year of projected cash flow after the loan payments have ended. As expected, borrowing reduces the NPV because the loan repayments lower the net cash flow during the repayment period. However, once the loan is paid off, as we saw in the 6th year, the projected cash flows are no longer reduced by loan payments. Alice and Bob may wish to extend their cash flow analysis even further beyond the end of the loan term in order to better assess the long-term value of the business expansion. So they might want to look into a 7th or 8th year. The problem there is, of course, the further you get out, the harder it is to predict things. I mean, things could be more optimistic, more pessimistic. They might want to do the analysis we saw before where you had an optimistic and a pessimistic prediction for some of the later years. It's another possibility. We have one final example in this lesson. And that's the case where you have multiple projects of similar risk, and we want to compare those and decide based on NPV which one would be preferable to use or go forward with. So that's what I have here. Some company has, say, $155,000 to invest, and perhaps they've taken different proposals from their employees, and they've come up with these 2 projects, A and B, and also with estimates of net cash flows over 8 years, which are shown here. So what we want to do is do an NPV analysis, and I'll show you that on the next slide. The table here shows an NPV analysis for project A and B, and the cost of capital here on the left column. And you can see here that project A is slightly better, slightly higher NPV, up to between 0.02 and up to 0.035. And then from 0.04 to 0.06, you have a slightly better NPV for project B. So, and then after 0.06, you kind of go into negative territory. So neither project makes sense there. So deciding on what project really would depend on what risk you believe these 2 projects are equivalent to in terms of the cost of capital. If you think the risk is roughly equivalent to 0.03 cost of capital, then you would go with project A, although it's pretty close. And if you thought, for example, the cost of capital was 0.045, 4.5%, then in that case you would go with project B, since the NPV is slightly higher there. Okay, so that was the last slide in this lesson. I have at least another lesson on capital budgeting, and then some lessons on other topics in financial mathematics.